The Internal Revenue Code allows a deduction from an individual's income tax for medical care expenses for taxpayers, their spouses, and dependents. Those expenses cannot already have been compensated by insurance, and the deduction only applies to expenses that exceed 7.5% of the taxpayer's adjusted gross income. As of January 1, 2013, the threshold increased to 10%, except that through 2016 it will remain at 7.5% for those taxpayers age 65 and above. As of January 1, 2017, all taxpayers will be subject to the 10% adjusted gross income threshold with no exception based on age. In 1996, the Internal Revenue Code was amended by the Health Insurance Portability and Accountability Act, HIPAA, to specify that medical expenses include qualified long-term care services. Numerous IRS rulings establish that portions of entrance fees and monthly service fees paid by independent living residents of continuing care retirement communities are deductible to the extent that they represent a charge or prepayment for future assisted living or skilled nursing care. The practice of most CCRCs is to provide their residents with a statement at the end of each tax year advising what percentage of the entrance fee and what percentage of the monthly service fee are apportioned as prepaid future long-term medical care. Because the entrance fee is a one-time only payment, its qualified portion can only be deducted from income taxes for the taxable year in which it was paid. However, the monthly service fee qualified portion can be deducted from year to year. So let's take a look at how this might work, with the caveat that you should always consult with a qualified tax accountant, tax attorney, or financial advisor whether the deduction is allowed in your circumstance. Let's say that you, the taxpayer, have income of $50,000 a year. Presuming you're 65 years of age or older, then your threshold amount that you must pay before a deduction is allowed is 7.5%, or $3,750. Now let's assume that your entrance fee is $250,000 and your community apportions 10% of that as payment for future long-term medical care. 10% would be $25,000. Let's also assume that your monthly service fee is $3,000 with 20%, or $600 monthly, $7,200 annually, apportioned by your community as payment for future long-term medical care. By adding the $25,000 portion of the entrance fee together with the $7,200 monthly service fee, you have $32,200 of future medical, which is offset or reduced by the 7.5% minimum threshold amount based on your annual income. So theoretically, you could enjoy a $28,450 tax deduction following the first tax year that you live in a community. And remember, you can continue to deduct a portion of your monthly service fee from your tax burden annually once you reach that threshold amount as set by the IRS.